If you live in Canada, your mortgage payment is about to change. That's not a forecast. That's a contractual certainty embedded in the structure of Canadian mortgage debt. Between 2026 and 2028, approximately $400 billion in Canadian mortgages will reset to current interest rates. Most of those mortgages were originated between 2020 and 2022, when the Bank of Canada's policy rate was 2.25% and 5-year fixed mortgage rates averaged 1.8% to 2.4%. Today, the policy rate is 3.25%, and 5-year fixed rates range from 4.6% to 5.3%. I'm John A.G., and this is the Collapse Files. In January 2025, the Bank of Canada published updated data on mortgage maturity schedules, showing that $398 billion in residential mortgages will mature and require renewal between 2026 and 2028. This figure represents approximately 22% of Canada's total outstanding residential mortgage debt, which stands at $182 trillion as of Q4 2024. The significance lies not in the volume alone, but in the timing and rate environment. The vast majority of these mortgages were originated during the pandemic period, when the Bank of Canada's policy rate was at 0.25% from March 2020 to March 2022. 5-year fixed mortgage rates during that period ranged from 1.6% at the low in late 2020 to 2.6% by early 2022. Borrowers who locked in those rates assumed, or were told by mortgage brokers, that rates would remain low for the foreseeable future. That assumption proved catastrophically wrong. Between March 2022 and July 2023, the Bank of Canada raised its policy rate from 0.25% to 5.0%, a 475 basis point increase in 16 months. It was the fastest tightening cycle in Canadian monetary history. 5-year fixed mortgage rates followed, rising from 2.4% in early 2022 to a peak of 5.8% in late 2023. As of January 2025, 5-year fixed rates have moderated slightly to a range of 4.6% to 5.3%, still more than double the rates at which most pandemic-era mortgages were originated. When those mortgages mature and borrowers must renew, they will face payment increases ranging from 40% to 60%, depending on the exact origination rate and renewal rate. Now examine the distribution of maturities. According to the Bank of Canada, approximately $142 billion in mortgages will mature in 2026. Another $136 billion will mature in 2027. The remaining $120 billion will mature in 2028. The wave is not evenly distributed. The peak hits in 2026 and 2027, creating a 2-year period of maximum stress. This timing coincides with another pressure point. Canadian households are already exhibiting signs of financial stress. The mortgage reset is not hypothetical, it is contractual. When a 5-year fixed mortgage matures, the borrower must either renew with the existing lender or refinance with a new lender. In either case, the interest rate is reset to the prevailing market rate. There is no option to extend the existing rate. The only way to avoid the reset is to pay off the mortgage in full, which is financially impossible for the vast majority of borrowers. The reset is automatic and unavoidable. Here's what makes this abnormal. In a stable interest rate environment, mortgage resets are routine and manageable. If rates have not changed significantly since origination, the payment increase is minimal. But when rates double or triple, the payment shock is severe. The Canadian mortgage market has never experienced a reset wave of this magnitude under such adverse rate conditions. The last comparable rate shock occurred in the early 1980s, when the Bank of Canada raised rates to 21% to combat inflation. But the mortgage market structure was different then. Most mortgages were shorter term and household leverage was lower. Today, Canadians are more indebted, home prices are higher relative to income, and the financial system is more interconnected and fragile. To understand where the system is breaking, you need to understand how Canadian mortgages work and how they differ from other markets. In Canada, the standard mortgage is a 5-year fixed-rate loan amortized over 25 or 30 years. This structure is unique. In the United States, borrowers can lock in a fixed rate for the full 30-year term. In Canada, the rate is fixed for only 5 years, after which the mortgage must be renewed. The amortization period, the time over which the loan is fully repaid, remains 25 or 30 years, but the interest rate resets every 5 years based on prevailing market conditions. This system works smoothly when interest rates are stable or declining. Borrowers renew at similar or lower rates and monthly payments remain manageable, but when rates rise sharply, the system creates a payment shock. Consider a borrower who took out a $500,000 mortgage in 2021 at 2.0% with a 30-year amortization. The monthly payment was approximately $1,148. When that mortgage matures in 2026 and renews at 5.0%, the monthly payment increases to $2,953, a 60% jump. For a household earning $100,000 gross annual income, That increase represents an additional $13,260 per year in housing costs. After taxes, the borrower is taking home approximately $70,000. The mortgage payment alone now consumes 50% of net income, leaving $2,830 per month for all other expenses: property taxes, utilities, food, transportation, insurance, and debt service on other obligations. Here's the trap. Borrowers cannot simply refuse to renew. If they do not renew, the mortgage goes into default, and the lender can foreclose. The borrower's options are limited. They can renew at the higher rate and cut spending elsewhere. They can sell the home and downsize or rent. They can default and face foreclosure. Or they can attempt to refinance with a new lender, but that requires qualifying under current lending standards, which are much stricter than in 2021. The federal stress test, implemented in 2018 and tightened in 2021, requires borrowers to qualify at a rate 200 basis points above the contract rate, or at 5.25%, whichever is higher. A borrower renewing at 5.0% must prove they can afford payments at 7.0%. Many cannot. Now identify who is trapped. Borrowers who purchased homes in 2020, 2021, or early 2022 are trapped. They bought at peak prices with minimal down payments and low rates. Home prices in Canada rose 45% between early 2020 and early 2022, driven by pandemic-era demand, record low rates, and speculative buying. A borrower who purchased a home for $700,000 in early 2021 with a 10% down payment took out a $630,000 mortgage. If that home's value has since declined to $600,000, a 14% drop, which has already occurred in many markets, the borrower now owes more than the home is worth. They are underwater. If they sell, they must bring cash to closing to cover the shortfall. Most do not have that cash. They are trapped in the property, forced to renew at higher rates or face foreclosure. Lenders are also trapped. Canadian banks hold $182 trillion in residential mortgages on their balance sheets. If defaults rise, the banks face losses. But Canadian mortgages are full recourse, meaning the borrower remains liable for the debt, even after foreclosure. If the lender forecloses and sells the home for less than the outstanding mortgage balance, the borrower still owes the difference. In theory, this protects the lender. In practice, it is difficult to collect from a borrower who has already lost their home and likely has no assets. The bank writes off the loss, which reduces capital. If enough losses accumulate, the bank faces solvency pressure. The government is also trapped. The Canada Mortgage and Housing Corporation insures approximately 40% of all Canadian mortgages through its mortgage insurance program. If a borrower defaults on an insured mortgage, CMHC pays the lender and assumes the loss. CMHC is a crown corporation, meaning its losses are ultimately borne by taxpayers. A wave of defaults on insured mortgages would transfer billions in losses from private lenders to the public balance sheet. The government would face a choice: absorb the losses and increase the deficit, or cut spending elsewhere. Either option is politically costly. Let's quantify the scale of the payment shock and what it means for household finances. Start with the average mortgage. According to the Canadian Bankers Association, the average residential mortgage balance in Canada is approximately $337,000 as of Q4 2024. Now scale that to the $142 billion in mortgages maturing in 2026. If the average mortgage balance is $337,000, that represents approximately 421,000 mortgages. If each mortgage experiences a $516 monthly payment increase, the total annual increase in debt service is $2.6 billion. That is $2.6 billion in reduced consumer spending or increased household financial stress. Extend that calculation through 2027 and 2028, and the cumulative payment shock exceeds $7 billion annually by 2028. Now examine the household debt service ratio. The Bank of Canada tracks the ratio of household debt payments to disposable income. As of Q3 2024, that ratio stands at 15.2%, meaning Canadian households spend 15.2 cents of every dollar of disposable income on debt payments. That is the highest level since 2007. The ratio was 13.4% in 2020, before the pandemic mortgage boom. The increase reflects both higher debt levels and higher interest rates. When the mortgage reset wave hits, the debt service ratio will rise further. If the additional $7 billion in annual debt service is distributed across Canada's 15 million households, the average increase is $497 per household. But the increase is not evenly distributed. It is concentrated among the 421,000 households renewing in 2026, who face an average increase of $692. For those households, the debt service ratio could rise to 20% to 25% of disposable income. Compare this to historical thresholds. Economists generally consider a debt service ratio above 20% to be a sign of severe financial stress. At that level, households have little buffer for unexpected expenses or income disruptions. Job loss, medical expenses, or vehicle repairs can trigger default. The current debt service ratio of 15.2% is already elevated. Adding the mortgage reset shock pushes a significant portion of Canadian households into the danger zone. Now examine the geographic distribution. The mortgage reset is not evenly distributed across Canada. It is concentrated in the markets that experienced the largest price increases during the pandemic: Toronto, Vancouver, and surrounding suburbs. In the Greater Toronto Area, the average home price peaked at $1.33 million in early 2022. A borrower who purchased at that price with a 10% down payment took out a $1.2 million mortgage. Compare the mortgage reset to income growth. According to Statistics Canada, average hourly wages increased 4.8% year over year in Q4 2024. That is below the inflation rate of 5.2% over the same period, meaning real wages are still declining. Nominal income is growing, but not fast enough to offset the mortgage payment increase. A household experiencing a 50% payment increase would need a 50% income increase to maintain the same standard of living. Wage growth of 4.8% does not come close. Now examine the refinancing constraint. Borrowers who cannot afford the payment increase at renewal may attempt to extend the amortization period to reduce monthly payments. But extending amortization from 25 years to 30 years reduces the monthly payment by only 8% to 10%. That is not enough to offset a 50% rate increase. The only way to meaningfully reduce the payment is to reduce the principal, which requires paying down the mortgage. Most borrowers do not have the cash to do so. Finally, compare the reset wave to bank capital. Canadian banks hold approximately $1.82 trillion in residential mortgages. If 5% of mortgages in the reset wave default, a conservative estimate given the payment shock, that represents $20 billion in potential losses. Canadian banks hold approximately $200 billion in total capital. A $20 billion loss would reduce capital by 10%, which is significant but not catastrophic. However, if defaults exceed 10%, or if home prices fall more than 20%, the losses escalate. A 20% decline in home prices would reduce the collateral value of the mortgage portfolio by $364 billion. If defaults reach 10% and recovery rates are 70%, bank losses would exceed $50 billion, reducing capital by 25%. That would trigger regulatory intervention and force deleveraging. This pattern, a wave of mortgage resets following a period of ultra-low rates, has occurred twice in recent history, and both times it ended in financial crisis. The first occurred in the United States between 2006 and 2008. During the early 2000s, U.S. lenders issued millions of adjustable rate mortgages and subprime mortgages with low teaser rates that reset after 2 to 5 years. Borrowers qualified based on the teaser rate, not the reset rate. When the Federal Reserve raised rates from 1% in 2004 to 5.25% by 2006, those mortgages reset at rates borrowers could not afford. Monthly payments doubled or tripled. Defaults surged. By 2007, subprime mortgage defaults reached 15%. By 2008, the defaults spread to prime mortgages. Home prices fell 30% nationally and 50% in some markets. The crisis destroyed Bear Stearns, Lehman Brothers, and triggered the worst financial crisis since the Great Depression. The key parallel to Canada is the structure. U.S. subprime borrowers qualified at teaser rates of 3% to 4%, then reset to 7% to 9%. Canadian borrowers qualified at rates of 2% and are now resetting to 5%. The magnitude of the payment shock is similar. The household leverage in Canada today, 182% debt to income, is higher than U.S. household leverage in 2006, which was 130%. The price to income ratio for Canadian homes is also higher. In Toronto and Vancouver, the average home price is 12 to 14 times median household income. In the U.S. in 2006, it was 8 to 9 times. Canada is more vulnerable, not less. A second precedent occurred in the United Kingdom in 1989 to 1992. The Bank of England raised interest rates from 7.5% in mid-1988 to 15% by late 1989 to combat inflation. Mortgage rates followed. Borrowers who had taken out variable rate or short-term fixed mortgages in the mid-1980s at 8% to 10% saw their rates double. Monthly payments became unaffordable. Home repossessions, the UK term for foreclosures, rose from 15,000 in 1989 to 75,000 in 1991. Home prices fell 20% nationally and 30% in London. The crisis lasted 3 years and pushed the UK economy into recession. Unemployment rose from 6% to 10%. The banking sector required regulatory forbearance to avoid failures. The pattern in the UK was similar to what Canada faces now: a rapid rate increase, a mortgage market structured around short-term resets, and highly leveraged households. The UK crisis began when approximately 10% of mortgages experienced payment shocks they could not absorb. Canada is facing a 22% reset wave. The scale is larger, Both the US and UK crises followed the same sequence. First, the central bank raised rates to combat inflation. Second, mortgages reset at higher rates. Third, borrowers defaulted or sold homes to avoid default. Fourth, home prices fell due to forced selling. Fifth, the price declines created negative equity, trapping more borrowers. Sixth, the banking sector faced losses, which tightened credit and deepened the downturn. The sequence is mechanical. The only variables are timing and magnitude. The mainstream narrative around Canadian mortgages focuses on the Bank of Canada as rate decisions and whether rates will be cut in 2025 or 2026. Analysts debate whether the central bank will reduce rates by 50 or 100 basis points and whether that will provide relief to mortgage holders. What they miss is that even if the Bank of Canada cuts rates aggressively, 5-year fixed mortgage rates will not return to 2%. The bond market sets long-term mortgage rates, not the central bank. The bond market is pricing in fiscal risk, inflation persistence, and global capital flows. The 5-year Government of Canada bond yield is currently 3.2%. Even if the Bank of Canada cuts its policy rate to 2%, the 5-year yield is unlikely to fall below 2.8% to 3.0%. That would translate to mortgage rates of 4.5% to 5.0%, still double the pandemic-era rates. Second-order effects are already emerging but are not widely discussed. Home sales in Canada fell 15% year over year in Q4 2024. New listings increased 8% over the same period. The combination of falling demand and rising supply is putting downward pressure on prices. The average home price in Canada declined 4.2% year over year as of December 2024. That may not sound severe, but it follows a 45% increase from 2020 to 2022. A 4% decline after a 45% increase is the early stage of a correction, not the end. If sales continue to fall and listings continue to rise, the decline accelerates. Now consider the rental market. Some borrowers facing payment shocks will attempt to rent out portions of their homes or convert properties to rental units to generate income. But the rental market is already saturated in many cities. Rental vacancy rates in Toronto and Vancouver are near historic lows, but rents are rising, which is attracting new rental supply. If hundreds of thousands of borrowers attempt to rent out properties simultaneously, rental supply will surge and rents will soften. That reduces the income offset for borrowers trying to cover higher mortgage payments. The strategy backfires at scale. Why does mainstream analysis ignore the reset wave? Because acknowledging it forces uncomfortable conclusions. If $400 billion in mortgages are resetting at unaffordable rates, and if borrowers cannot refinance or sell without losses, the logical outcome is a wave of defaults and a housing price correction. No one in the financial services industry, real estate sector, or government wants to say that publicly. The industry depends on confidence. Mortgage brokers, real estate agents, and bank executives all have an incentive to downplay the risk and emphasize the resilience of Canadian borrowers. The government has a political incentive to avoid acknowledging a housing crisis in the making. So the analysis stays focused on near-term rate cuts and economic resilience, and the structural risk is ignored. The media amplifies this bias. Real estate coverage in Canada is dominated by industry insiders and economists employed by banks. Their analysis is constrained by their employer's interests. A bank economist who predicts a 20% home price decline and a wave of mortgage defaults risks being fired or sidelined. So the public analysis is optimistic, even when the private risk models are not. Investors and homeowners are left with incomplete information, and by the time the risks materialize, it is too late to adjust. What most people miss is that the mortgage reset is not a problem that can be solved by rate cuts or forbearance programs. It is a structural mismatch between household income, debt levels, and housing costs. The only way to resolve it is through defaults, price declines, or massive fiscal transfers to subsidize mortgage payments. All three outcomes are destructive. Defaults destroy household wealth, price declines destroy collateral values and bank capital, fiscal transfers increase government debt and require either higher taxes or spending cuts elsewhere. There is no painless solution. When $400 billion in mortgages are contractually scheduled to reset at rates 150% to 200% higher than origination, the signal is not about interest rates. It is about the fragility of a financial system built on the assumption that rates will stay low forever. That assumption has been embedded in Canadian household finances for over a decade. It has driven home purchases, consumption patterns, and borrowing decisions. When the assumption breaks, the entire structure built on it becomes unstable. The broader implication is that housing is no longer a store of wealth. It is a source of financial risk. For most Canadian households, the home is the largest asset and the largest liability. When home prices are rising and mortgage payments are affordable, the asset appreciates and the liability is manageable. But when prices fall and payments spike, the liability overwhelms the asset. The household is left with negative equity, unaffordable debt service, and no exit. Wealth is not stored, it is destroyed. What breaks first is not the housing market or the banking system. What breaks first is household liquidity. Households facing a 50% payment increase have three options: cut spending, liquidate assets, or take on new debt. Most households have already exhausted the second option. Savings rates in Canada are near zero. Liquid assets, cash, stocks, bonds, have been drawn down. The only option is to cut spending or borrow. Cutting spending reduces economic activity, which slows growth and increases unemployment. Borrowing increases leverage, which makes the household even more fragile. Either path leads to deterioration. History shows that mortgage crises spread beyond housing. In the US in 2008, the subprime crisis began with mortgage defaults, but ended with a global financial crisis, a 10% unemployment rate, and a decade of slow growth. In the UK in 1990, the mortgage crisis triggered a recession, bank stress, and political upheaval that contributed to the fall of the Thatcher government. In both cases, the housing crisis was the trigger, but the broader economic damage was far worse. Canada is not immune to this pattern. The warning is about confidence. The Canadian housing market depends on the belief that homes always appreciate, that mortgages are always affordable, and that the government and central bank will always intervene to prevent a crash. That belief has been tested before, in the early 1990s and again in 2008, but it has always held. This time, the debt levels are higher, the price-to-income ratios are more extreme, and the central bank's capacity to intervene is more constrained by inflation. If the belief breaks, if Canadians begin to doubt that housing is a safe store of wealth, the selling accelerates, prices fall, and the crisis becomes self-fulfilling. $398 billion in Canadian mortgages will reset between 2026 and 2028. That is not a forecast. That is a contractual certainty. Those mortgages were originated at average rates of 2.0% to 2.4%. They will reset at rates of 4.6% to 5.3%. The payment increase for a typical mortgage is 40% to 60%. For hundreds of thousands of households, that increase is not absorbable through income growth or spending cuts. It requires selling the home, defaulting, or taking on additional debt. All three outcomes create stress for households, for lenders, for the housing market, and for the broader economy. The data is public. The Bank of Canada publishes the maturity schedule, statistics. Canada publishes the household debt and income figures. The Canadian Bankers Association publishes the average mortgage balance. Every number in this analysis is verifiable. What is missing is acknowledgement. The institutions responsible for managing the system, the banks, the regulators, the central bank, the government, will not admit that the mortgage reset wave represents a systemic risk, because admitting it would undermine confidence. So they emphasize resilience, point to low unemployment, and suggest that rate cuts will provide relief. But rate cuts do not change the contractual reset. They only reduce the magnitude of the payment shock by 50 to 100 basis points. A 50% payment increase becomes a 40% payment increase. That is still unaffordable for households already stretched to the limit. The pattern has appeared before. In the US in 2007, a wave of adjustable rate mortgage resets triggered the subprime crisis. In the UK in 1990, a wave of mortgage resets triggered a housing crash and recession. The sequence is always the same. Low rates enable overborrowing, rate increases trigger resets, payment shocks force defaults, defaults push prices lower, and falling prices trap more borrowers in negative equity. The cycle is mechanical. The only question is the magnitude and the timeline. In Canada, the magnitude is $400 billion. The timeline begins in 2026. The consequences are already being priced into falling home sales, rising inventories, and softening prices. What has not yet been priced in is the scale of the defaults, the depth of the price correction, and the losses the banking system will absorb when the collateral value of $1.82 trillion in mortgage loans declines by 15% to 25%. The reset is not coming. It is already here.